Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I'm back to talk about stock market investment strategy utilizing closed-end funds. So to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. In theory, not a lot. I mean, the cat is asleep, but we'll see if he wakes up. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So, first and foremost, I honestly didn't know if I would get to make this video. Uh, it's been a crazy week. Yes, I got a lot of stuff done. It ended up being a lot busier than I thought it would be. Um, Made some great progress on the dividend book. But I mean, honestly, the last week before term ending ended up being pretty chaotic all around, to the point where we ended up having a school event yesterday, and we were just not dead, but we were just exhausted afterward. So, in prepping for the video, I had so much to read. I honestly didn't think I could get it all done in a day, but I did get it all done in a day because I realized a lot of it was uh, duplicated material in the sense of, I mean, between the people I pay for the Contrarian Outlook and other people, uh, other agencies, businesses sharing financial news, a lot of that material was just recycled through. So there was still a lot, just not as much as I realized. And my girls are out at Christmas parties, so I'm using the time to do finances and this, and it worked out. So I still have a lot on my end that I have to take care of. I got books to finish. I really do need to do a deep dive throughout the closed-end fund master and really update tabs, update everything. But I still wanted to make a video leading up to Christmas, and I still want to make a video leading, like after Christmas, just because there is a lot going on. And I would talk about more of my finances and my financial decisions on these videos, but I'm trying to keep it just stocks or just closed end funds in that strategy. I love finances. I love talking finances. I like talking about the strategy behind decisions. And I think I said this last week, when you make financial decisions, most people see the outcome and they judge the outcome. And if they don't judge the outcome, they're judging you based on the decisions you make causing that outcome. But they don't see everything you have to consider and every thought running through your head and all the other stuff that you did in order to make that decision. They don't see the options, they just see the one thing you did. And stock market's the same way, right? But I would love to have those discussions and share what I'm dealing with on my end. But this video isn't really for that. That's more in regards to the books I'm writing and the, I don't want to say the culture, but it's almost like the forum, right, or the community that I want to create. I want to be able to talk about stock investment strategy and closed-end funds more than just what's on the commentary section of videos on YouTube. And I also want to talk about the daily financial struggles we have, or maybe not the daily, but the monthly financial struggles we have, more than just bearing your burden in solidarity. There's got to be more ways that we can help each other out, and even if it's not so much sharing your burden, it's just giving you somebody else that you can talk with about what's going on. So that's my goal, and I would love to do it on this video. It's not that it's not the place. I mean, it's a financial video, but it's also in trying to streamline content and make it less muddy and try to make it more focused on closed-end funds and general updates as opposed to everything else going on. So, in looking at stocks this week, the herd is running scared, and I'm past the point of trying to understand the herd. I get they're getting pumped fear from six ways to Sunday, like from everybody. But I see so much hope and promise in this economy and in the coming economy. So here's the four things. Four, we'll say the top four stories from the week. President Trump has promised to look at housing reform in 2026. Home prices have fallen since he took office in January, but overall, they're still up about 80% from 2021. And rural home and land prices have seen an even larger growth or spike or increase or whatever you want to call that than urban homes. Now, I've seen my I've seen my value go up both in what people would buy and also in what my tax office would charge me for. And property taxes will get me way off base. But thankfully, there have been more discussions about ending property taxes. Ending property taxes, President Trump has said the same. Ending property taxes would be an amazing benefit for the American taxpayer. Think about it. If you bought a pair of shoes, do you get taxed on those shoes a year later? If you buy a coffee cup on Amazon, do you get charged tax a year later? When you bought your house, you paid the taxes for it. Why are you still paying taxes for it? And all the utility districts, and like I live in Southeast Texas, so I get dinged for the Port of Houston. I get dinged for this county. I get dinged for this, that, and the other emergency services. I'm not saying that all of those things don't have a price because they do cost they do cost money in order to run. However, all of those different boards raising taxes without your awareness or knowledge or input is taxation without representation. I got our tax bill in November. It's due in December. That's outrageous. And yet that's the current uh, I don't know, that's the current way of doing things in Texas. That just sounds fucking foolish. So we need countrywide, we need property tax reform, and we need more input. We need more consumer input and control of how those individual boards are making decisions for taxes. So, yes, President Trump promised housing reform. He's also pushing for getting rid of property taxes. That's all well and good. It's just not there yet. But I'm hoping we're headed that way. What would help in that would be the Federal Reserve cutting rates, not so much the individual boards, but the overall taxes. So the say the cost of things, taxes, insurance, everything that goes into property taxes. Uh, but the on the Federal Reserve rate cuts, honestly, the fix seems to be in. The Fed will keep cutting rates. Now, whether Jay Powell does it or somebody else really doesn't matter. But it when say when Powell is replaced, or maybe if he's replaced early, it comes down to a tale of two Kevins. You have Kevin Hassett saying that the Federal Reserve should cut early and often, and his complaint is that the Fed has been generally behind the curve, behind the times, and he's spot on with that. Then you have Kevin Warsh telling President Trump that borrowing costs must come down. Well, that means that the federal rate has to come down. So the Fed is going to keep cutting, right? And that's great. That's great for the consumer. That's great for everything, especially when we have data saying that inflation is falling super fast. All great data points. And I'll get back to what the federal rate cut means and how we're targeting. The other big news for the week is that TikTok seems to have found some type of U.S. management housing. I think it'll still be a Chinese-based company, but they at least have a U.S. overlord um, that will manage the company on the US front and store all the data. And that's, from my standpoint, that's neither here nor there. Um, you and I both know that all the apps on our phones track us and our phones track us. So having China do it or Alexa do it or the US do it or whoever do it really doesn't matter because they all abuse our privacy. Now, would I like them to not abuse our privacy? Oh, yes. But at the same time, I don't know what's going to change on the TikTok front and how they monitor its users. What I also don't know is that whoever acquires the tech company, the biggest issue I have with TikTok, not so much the privacy. I mean, the privacy universally, violation of privacy universally is a big deal. But even beyond that, TikTok suppresses and violates free speech. They don't, it's less of a social media platform more than a cultivated news outlet. So if it has a US overlord, are they going to abide by the Constitution and the Bill of Rights? The Bill of Rights is you can say anything. I mean, you can say anything. And remember, Facebook police, um, Facebook jail, that's a thing on TikTok now. So, and I get that's political and not financial, but at the same time, it's both. So, getting back to the Fed cut, with the Fed continuing to cut rates and how we target stuff in this environment, we have got to scoop the best deal in this environment with a long-term perspective of what will still do amazing in the future. And with the Fed cutting rates, right, or with the new guys coming in, or the new guy coming in saying that he's going to cut rates, bonds are the go-to. I mean, that's where I don't get the herd. The herd is freaked, and we saw a little blip. It doesn't make me panic. It really makes me see a buying opportunity. So the idea of bonds before cuts sounds great, and the continued idea of bonds during cuts sounds great, and the ongoing idea of bonds once the herd arrives late and lifts our prices, that sounds amazing too. So I I really don't. I don't. I understand the herd and that they're running scared, but at the same time, there's such a stark contrast between how I perceive the reality of the US market and the hope in our economy. I mean, the GDP is pushing 4%. Inflation is falling faster than anybody thought. Tariffs, which we all knew, don't contribute to inflation. There's money pumping in like crazy to the US economy. All of those things are amazing. And yet you have the herd scared and kind of taken the market. I mean, the the Santa rally, like the rally that happens the last 5 days of the calendar year and then kind of bleeds in the next couple of days of the next year, it should be on. And the market overall is up and the economy is amazing. But if you look at the fear and greed index, you'll see people are scared and it just doesn't make sense. But I can't explain the herd. And I'm long past making excuses for them, right? They're unlearned, I don't know, they're poorly taught, that they're herded this way and that. I can't explain that. And it's not my business. I mean, I would love to educate more people and help them escape the herd. But at the same time, eh, I'm not tracking the herd because I'm out in front of the herd. We've been in bonds for years. It's the targets haven't changed. The Fed cuts only reinforce the targets. So we've been in bonds and bonds proxies. We've been into end-to-end technology. We've been in end-to-end energy, or say we've been in technology beyond the big guys, and we've been in end-to-end energy, and that has been going on based on how we're reading the current market, and it's not based on the herd at all. That's just reading the Fed and the trends and the macro data and the micro data and seeing what's honestly seeing how the market will shift. So I don't understand the herd. I hope that they wake up to the reality of things, but I don't know if they will. But if they do, like where it, we have outpaced like if that's the herd, we are outpacing the herd and staying in front. If it's not like they're going to catch up and we're going to stay stationary, right? We're going to keep moving. We would like them to catch up and kind of lift our pricing, but if they don't, they don't. So I can't explain the herd, but my how to say this well. My job is not to make decisions for the herd. My job is to make decisions for me and do the best possible thing for me to optimize my money to scoop deals in the present market for the long term with a much bigger picture in mind. And when I make these videos, the whole purpose of making these videos, honestly, when I started was to justify what I'm doing. But at the same time, they gave me an amazing avenue to teach and to explain and to share my thoughts about the market, but also just I don't know, like bring recognition to closed-end funds and how those are so much better than single stocks. And the herd has always been part of my conversation because where we are is so much different than how the herd invests and how much different than how they read and play the market. It's like it seems as though we're about to hit another bond bull, but the reality is we've been in that mindset for years. It's been that way. Even with high Fed rates, bonds have been amazing. And now with lower Fed rates, bonds can be more amazing, should be more amazing. So on our end of things, we've been the bull in the China shop, just crushing it. The herd has been somewhere else, right? It's the Indiana Jones thing. Like they don't know where they're digging. They're digging in the wrong place. And that's fine. We would like them to be in our China shop. But at the same time, we've been raking deals in our China shop while they've been off doing whatever. So let them freak out and use their fear for your advantage. Buy amazing things now that'll be amazing, even better, even more amazing later. So here's what the list looks out. Enough of my rambling. Here's how the list looks. Let me share my screen. No, not that screen. So I updated the tracked funds. I did not update the full list. That is a deep dive for a different day. So here are all the targets based on discount. All of them are significant. Now I'll say there's a fund on this list that doesn't meet the discount metric, but on my end, it would be a great dollar cost average pickup. There's about $1 difference between IGR's current price and our uh, average share cost based on our buys. And it doesn't meet the discount metric, but at the same time, it would be a great dollar cost average move. But if we're trying to optimize our investment, and yes, I could make a great argument for doing that with IGR. If we're trying to optimize the investment, we want to We want to buy based on discount. So if we categorize, I mean, we're pushing monthly. I'm willing to consider a quarterly pair to a degree, but DX is great for volatility, pre-volatility, not during. Aberdeen, I'm not a fan of. Gabelli, yeah, and MCN, not my jam. USA would be interesting if it were closer to the ex dividend date, but having passed the ex dividend date and they pay 1369. If we bought it today, the first dividend we would see would be March, and that's just a little too far out for me. So that leaves us with all monthly payers. So if we're going to demand the best and be highly selective, all of them have significant discounts. All of them pay monthly. We want to demand a yield on my end greater than 9%. And there have been some exceptions to the rule, like 9% or above, unless I can justify it. HFRO price has been climbing. It's a bond proxy in real estate, primarily North America, really all North America. KYN is end to end energy. NML, same thing, end to end energy. RFI, um, still North American based. Let's see. HFRO is primarily US, primarily. RFI is primarily North America. But if we're going to be hyper selective and demand that 9% dividend, then they drop from the list. So the goals are bonds and bonds proxies, uh, technology beyond the big guys, and end to end energy with a 9% or better dividend. So what does that leave us with? Well, the as erratic as the market is, the CLO market right now is still erratic, too erratic for my comfort zone. So those guys get nixed. OPP is not generally in the discount, or at least this significant of a discount area. Hicks doesn't beat the market average. EIC is still CLOs. FSCO is BDC. River has a big BlackRock part, and that's not my jam. Yep, we're still looking at CLOs. We already have bonds. So if you're new to my videos, welcome. One, thank you for coming. Two, we're my portfolio is already well stocked with bonds. So whatever I pick up has got to be better than what we currently possess. And there's really only a few funds out there that I would be interested in picking up. Let me go back. So if we're going to target in that order, bonds and bonds proxies, and then a split between technology beyond the big guys and end to end energy. End to end energy is no longer on the list. Utilities, but that's not like oil, and that's generally not oil and natural gas. Utility is more bond proxy, although you can make a case for the others as well. So RLTY, Cohen & Steers has RLTY, RQI, and RFI. They're all about the same portfolio. I mean, there's a little nuance there, but we already own RFI, and it is in discount. It's rarely in discount. It is in discount, but it still didn't hit the metric. And I don't like buying a duplicate portfolio just for the hell of buying something in discount land. DLY is a sister fund of a bond fund we already own called DSL, and DLY is a different portfolio than DSL. So this would stay. Newberger is 5G Tech. CIF is a roller coaster bond fund. First Trust, I don't know much about. RA is, let's see, Meggie is a term fund. Aberdeen, I'm not a fan of. PIMCO, I would buy. we don't own it. I mean, so we cash brokerage in light blue, Roth, and darker blue. We don't own a PIMCO fund. That would be on my hit list. Now, which PIMCO fund? I mean, that there are some good options. So PDI, PDO is not up here. PHK, PTY. They're almost always in premium land. So even though it says 850 and pick any other fund, it would not make the list because it's in premium. It makes the list because its normal is sitting close to 21% premium. So 850 is actually a discount for the fund. So that's 5% better. That's about 2% better. That's got the better deal based on historical data. Uh, PDI's got the better yield. So it's kind of a toss of the dice, but that one would probably drop off. All right, BRW, I've talked about at length before, FCO as well. Nuveen, we already own municipal bonds. I don't really want to add more. HGLB is a mix of funds, but their value, like 30-ish% of their portfolio is in the mid-wave wireless section. And that it's an interesting size of the portfolio. That being said, I if I'm buying in this if I'm buying in this market, and I am looking ahead, technology will still be big. Mid-wave wireless, I think, will still be big. Uh, but if I'm going to hyper focus on bonds, even though they have a bond section of their portfolio, it's not the entire portfolio, which you could argue for and against. Uh, but also on my end, I want to buy funds where I can get a lower dollar cost average. So at HGLB, we bought when it's like upper sevens compared to at nine, there's that gap. And in the grand scheme of things, it's not going to be a huge increase. Like it won't. I could just as well argue FCO on the other end, it would lower our average cost per share. Buying HGLB would raise our average cost per share. As you buy throughout your time in the market, you're going to buy on that cycle of things, and you're going to overall have a dollar cost average based on whatever time you buy. On my end of things, I always try to buy under. I don't like buying over. Uh, so if I'm buying according to that, if I really hyper focus and say if it's going to raise my dollar cost average, it would get off the list. So let's look at NBXG 1392, Megi 1257. 1392 would be higher. 12, yeah, so both higher there. So I don't own a PIMCO fund. We don't own this double line fund, so there's no pre-existing baseline data for. OPP, it's a shared, and yes, so double line there, double line partially there. That's interesting. It's an interesting fund. So without knowing what's in it, I would pass just because I don't know if it's bonds or other special acquisitions. I don't know how their portfolio is structured, but I'll leave it because, well, yeah, between price. So discount is significant, monthly payer, but price, I love things that are under $10. And then it pays a hefty dividend. So this would be the list, but there's only so much money. So I like buying these two in matching amounts. Like if I'm going to buy $200 or if I'm going to buy 200 shares, I would buy one if I had if I had the money for 200 shares worth of BRW and that was it, me personally, I would buy 100 shares of BRW and 100 shares of FCO. I like how they work together on my end of things. Which PIMCO fund would I pick up? I would probably pick the bigger dividend, even though that's a I say that I would pick the other one because it's cheaper, one, and in the long run, it has a greater discount. But if you wanted to compare the apples to 100 shares, I mean it's got a 80, gosh, 264. That's quite a difference on the overall annual dividend. $120 is quite a big deal. But it makes sense seeing that the dividend is almost double. So you can't buy everything. I mean, maybe you can. Maybe you have enough money to buy everything, um, but you can't buy everything all the time. So what would I pick up? If I was building a portfolio and starting at scratch, all of this looks interesting. Since I already own BRW and FCO, I would probably prioritize that, especially since I can get a better deal for both. And it would lower my overall share price. But honestly, all of it looks interesting. Um, and it's all bond focused. I mean, FCO is bonds, but it's also it's a business development company. BRW does more than just bonds. I like their shareholder activism. PIMCO funds for sure. Uh, it, in the bond world, yeah, PIMCO is pretty much the bully of the bond world. DLY is amazing. Just along DSL, Gunloch runs that program, runs that ship pretty darn tight. And to know that he's involved in that OPP, that's tempting too. So I'm not buying tomorrow. I'll be honest. I got way too much on my plate that I need to resolve. Um, and resolving that would give me more headspace to work through this. Uh, but say, I'll put it this way, I need to fund my Roth for the year. And I know I've got until April, till I file taxes. I have until April to fund this year's Roth. But if I fully funded the Roth for the year, all of this would be pretty darn tempting. I mean, yeah, we own BRW and FCO in the Roth as it is, but this other stuff, acquiring all of it in the Roth, because that's really how I want to structure the. I think going forward, how I would structure Roth versus cash brokerage. Cash brokerage would be more. Hmm, the Roth, I think, would be more like consistent dividend income, regardless of the market, and that's U.S. bonds, international bonds, business development company, and some of that cyclical based on interest rates and everything else. But stuff I really don't have to change out versus the cash brokerage. I'm more willing to pick up short term stuff uh, like ZTR. ZTR is a hybrid fund. It's hybrid, like 75/25 bonds to stocks, uh, which honestly, if the share price lifts in a lower rate environment, I would sell that fund. USA and ASG, we picked up they're great blue chip companies. They pay quarterly, but they're more short term bounce holds. Like their pricing has done amazing the last 10 years. But if you look at it, it's very cyclical based on interest rates versus ADX just gains over time. ADX, regardless of the market, just powers through and continues to gain in value. So I would put ADX in both funds, uh, but I'd rather hold USA and ASG in just the cash brokerage. Um, but yeah, that anything I say will just keep going in circles, or I guess anything more I say will just keep going more in circles. And uh, I don't think I need to add to this. So, in closing, I'm going to say something and I'm going to do something that 95% of people would say it's bad to do in videos. But I don't care, or at least I do care enough about you to tell you something that most people won't. So, financial matters aside, it's finally Christmas week. And though it feels more like summer in Southeast Texas, it's finally Christmas week. And we can't control the weather, but we can control ourselves. So, my advice is in general, really across the board, do the best you can, or do the best you can with what you have. And that's in life and in everything else. But how you apply that is going to be different person to person. So enjoy the time, enjoy your family this week, be safe on the roads, make the best long term decisions in the ultra short term world. And don't forget that Christmas is bigger than packages, tags, and toys. The secret of Christmas is hiding in plain sight. It's not the quest for more or the best deals or scooping the best deals in this current stock environment. It's bigger than that. It's beyond the nonsense and the noise. It's beyond the best deal and the lowest price. The secret of Christmas is that God loved us so much that he changed history to save us from ourselves. And he chose us and loved us when we were at our worst. And he hopes that we choose him over anything else we could choose. He doesn't need us, but he wants us. And and we desperately need him, but we struggle to want him consistently. It's the greatest love story ever told. If you've never read the Bible, if you've only heard about the Bible from somebody else, then you should read it for yourself. And read it not so much looking to prove your point, but just read it. It is the greatest love story ever told. And God changed history for us, for you, for me, for everybody. And you still have the choice to believe it and accept it. It's the story of two hopes. It's the story of two outcomes. The hope to live eternally in heaven through knowing Jesus Christ, or the false hope thinking that you're good enough on your own without him. One gets you to heaven, one gets you to hell. And you choose which way you want to go. So, whatever you have planned for Christmas, I hope that you learn there's more to Christmas than traditions and commercialism. I love the traditions. Like we go to church on certain days, we do this, we do that, we go look at lights, sometimes we get coffee and hot chocolate. Currently it's low 80s, so maybe we'll even get ice cream. I love the time with my family. But Christmas is more than that. And the Christmas movies and the funny Christmas movies and the time and the food and the people you don't see all the time. But it's more than that. I hope you meet and get to know Jesus Christ, or you rekindle a guttering relationship with him. And I hope that you make a life altering decision that completely changes your individual history. Because the truth is, you and I may never meet, but I will see all of you Christians one day when we meet in eternity. So I wish you a great week. I wish you a safe week. And investment wise and finances wise, I wish you a successful week. There's so much hope in this economy, so much hope for a better day for Americans that you're just not going to hear in the news. And as amazing as that is, there's still so much more hope out there for you if you're willing to look for it and if you're willing to see it and believe it. So I wish you a great week. I wish you a Merry Christmas. And I will see y'all next week on a different video. So have a great week, everybody. Bye bye.